Markets are about stories, not just numbers. In a way, all money is fiction. It works only because most people believe in the same stories. The reality is that markets trend on stories, not just numbers. People make decisions based on what they believe will happen, not just the facts in front of them. If everyone believes in the same story, it becomes powerful and it will move the market. If you pick up any financial newspaper, you'll see that every single day a journalist is tying the price action or the price change to some story. Why? Well, because investors crave the story. Numbers on their own are boring. No one cares about PEs and gross profit and all that sort of stuff. Investors want a narrative that they can make sense of as to why things are happening. Your job as a trader is to understand the stories and, most importantly, the implications those stories have on the markets you trade. Let me ask you this. When was the last time you read a financial article that simply said the following? The market went up today because there were more buyers than sellers. You've probably never read an article like that. Why? Well, because in the financial world, every price movement is tied to a story. It's human nature. We all want an explanation for why something happened. Ultimately, we want to know a story. We want to be able to understand the story to make sense of the chaos. It's far easier for you to compartmentalize and believe that the reason Nvidia is at record highs is because AI is the future that'll change everything, just like the internet did. This is a narrative that sells. Clearly it does. Nvidia was a $300 billion company 2 years ago. Now it's a $3.3 trillion company. That's 1,000% increase in simply 24 months. Does it sound like a bubble? Maybe. Why do people keep buying it then? It's got 40 times earnings. What reasonable person is going to buy such an expensive company? Well, people who believe the story is more important than the numbers. And ultimately, they are being rewarded. If we look at Tesla stockholders, they got rewarded for so many years believing in driverless AI technology that's going to destroy Uber. And we simply have not arrived at that point. US bondholders were cleaning up this year because a recession was guaranteed. It was just around the corner. Guess what? The recession never arrived. Bitcoin maximalists, they believe that Bitcoin is going to $1 million and it's the future of money. And yet we're not at $1 million and it's not the future of money. Ultimately, what makes a really good trader is someone that understands the story, but most importantly, they're capable of following and staying with the story. A story is not what you believe to be true and right and fair. Ultimately, a story is what the market believes to be true and right and fair. Let's see what happens when a story ultimately comes to an abrupt end. This is the Google chart. If we go back to Q2 this year, 2024, ultimately we had the CFO come out and tell us that CapEx was up 13 billion, but that investments in AI are long-term, and unfortunately, they're going to take time to pay off. Ruth Porat told the truth. She told the market the truth. She said it the way it was. Ultimately, she told the market the wrong story. She told the story that investors didn't want to hear, and so they punished her, and Google's share price dropped 23%. Not just Google's share price. Ultimately, it drove all of the AI stocks and all of the tech stocks significantly lower. This is what happens ultimately when a narrative changes or when a narrative flips. Now, we've heard this narrative as of overnight, okay? We've got this promise from Tesla's Elon Musk telling us that robotaxis are going to come next year. They're going to be $30,000. They're going to change the world. Well, will it? Will it not? Currently, Tesla's up 15% on the day, right? Is that going to continue? Well, of course it can. The reality is that these narratives gain traction. They stick around until they are no longer the key narrative. Now, this is a fantastic tool. This is a rebasing chart. And what it does is it shows us relative performance. What you're looking at here in the green is Nvidia. And in the purple, you've got the NASDAQ index. And in the orange, you've got Google stock. Okay. And the red line, the red vertical line back in July is when ultimately we had Google release their Q2 earnings. And what you can see is that ultimately everything got driven lower. But eventually, narratives reestablished themselves. No one stopped believing in AI. Nvidia is back at record highs. Where's Google? Okay. Still well off record highs. Okay. Still well off where it was at the start of the year. It was up at some point this year, 36%, and it's now only up around 17, 18%. The point is is that if you tell the wrong narrative, the markets will trade that narrative. It doesn't matter how much you believe in it. Ultimately, the market trades off narratives. Now, if we look at NVIDIA, okay, NVIDIA also sold off. We can see quite an aggressive sell-off in NVIDIA, right? But why is it that NVIDIA is back at record highs? Well, because NVIDIA hasn't stopped telling the story they've been telling for the last 2 years. What is that story? Well, they keep telling us there's so much demand for their chips that they can't keep up. There's so much demand for their chips that they keep beating earnings and keep beating revenue forecasts every single release. At the end of the day, the narrative continues to stay strong. And so long as it stays strong, we have to stay with the narrative. Now, the day the market starts telling us that NVIDIA orders are falling away from some of the big tech names, or perhaps competitors are bringing new AI chip supply online, well, that is a day that perhaps we're about to get a narrative flip. But until then, we have to simply just blindly believe in the future of AI, whether the numbers make sense or not. Market narratives aren't just about what's the truth or what's a lie. They're about what people believe. And what people believe moves the markets and it drives decision making. Whether it's the story about Tesla and driverless technology, or it's the belief that the Fed is going to cut aggressively to help the Democrats get into power, at the end of the day, investors trade off the stories they believe. They trade off the collective belief of investors. Now, let's summarize market narratives, and then we're going to move on and show some examples. 3 key things to note. Narratives drive price, and often more significantly than you expect. You're going to see this when I show you a few examples, but narratives don't just last 1 week, 1 month, okay? They can last a couple of years. Now, being smart and trying to go against the narrative just because you think you have some deep insight of what the future holds, it's not a good long-term strategy. Stick with the collective belief system. Don't form your own beliefs, okay? Second, always own the narrative. It doesn't matter that the story hasn't changed for 12 months. So long as investors still believe in it, they will want to own it, okay? Perfect case in mind is AI and NVIDIA. The narrative has not changed for over 2 years now, regardless of how expensive you think it is. Until that narrative changes, okay, you've got to own it, believe in it, and go with the collective belief. And then finally, when the narrative does change, forget the old narrative. Okay, there's a new story in town. Go with it and pivot to the new narrative. Don't sit on old narratives. Remember the old narratives. And this is very crucial. You'll see this in a minute. We do see narratives repeating themselves. And I'm going to show you this with an example of Bitcoin, with gold, with oil. I'm going to show you ultimately how these narratives have happened in the past and how they'll ultimately repeat in the future. Okay, stories repeat, and investors will respond to those stories in the same ways they did in the past when they arrive in the future. Okay, now, some of those current narratives that we're going to talk about, we'll talk about Bitcoin. Okay, it's very topical, it's a very interesting one, and it's got quite a fun little narrative. It's got some really key factors that ultimately people tell themselves, the story they tell themselves. And I'm going to share those stories with regards to Bitcoin and gold. But ultimately, Bitcoin year to date's up 61%. Gold's up 33%. Okay, why? Well, because there's a story that's being told in both of these markets. If we look at oil, for example, okay, oil and China are very closely correlated in terms of the story. When the story of China is weak, well, oil is weak. That's why oil's down 4.5% year to date. If we look at ultimately this idea of fiscal spending and higher yields, well, the narrative there is perhaps not as strong as what the newspapers like to believe. And this is one of the key things you'll come to understand, is that you've got stories that are believable, that drive collective decision making, and then there's just stories that people want to tell because perhaps it sounds intelligent. Okay, and this is a key thing you need to differentiate in terms of narratives. What is something that moves the price, and what is just a story that people want to make up and actually doesn't have implications on price? Okay, now let's look at them. We'll start off with Bitcoin. There's 3 things that drive Bitcoin. There's 3 key stories you need to understand about Bitcoin. Okay, think of these as the fundamental catalysts that drive the price of Bitcoin over long trends ultimately. The first is dollar devaluation. Okay, if you go back to the onset of Bitcoin in 2013, don't forget it was born of the era of the financial crisis. It was born as a direct result of the financial crisis, which is we're not comfortable with central banks or banks in general controlling the flow of funds in the world. Okay, because at the end of the day, they were reckless and they nearly blew up the system. Okay, and Bitcoin was born. Now, obviously, Bitcoin in its early days was just sort of a bit of fun. But ultimately, it began to establish its own fundamental drivers in 2016, 17. That's when we can see, it really started to get a little bit of limelight somewhere around, Q2 2017. Okay, and what really drove this, what ultimately drove this, was a devaluation of the dollar, a steep devaluation of the dollar over a period of 3 months of around 10%. Okay, it was at that time that people started to pay attention and say, well, hang on a sec. If I'm in the United States and I have dollar assets and I've just lost 10% of my wealth simply because the dollar's devalued by 10%, I need to be able to hedge against that. And so what happened? Everyone said, well, we've got this new thing called Bitcoin. Perhaps it's a hedge against weakness in dollars because it kind of acts like a fiat. I can move from one into the other. Of course, it doesn't really have much of a medium of exchange and it's very expensive. But ultimately, if I don't want my money to be in this thing called dollars, I could just put it into this thing called Bitcoin. Okay. And so what we notice, if we compare every time we have a significant drop off in the dollar, okay, what we notice is that we get a significant rise in Bitcoin. Okay. So we can see there's a very direct correlation between when lows are formed in the value of the dollar and when the lows are formed in the value of Bitcoin. Okay, so there's a natural tendency when there's some significant dollar devaluation, Bitcoin tends to outperform. Now, of course, yes, Bitcoin is priced in dollars, right? But ultimately, the key takeaway is when there is a lack of confidence in the United States dollar, that's when we see money moving or flow of funds moving into Bitcoin. Okay, so it acts as a hedge against devaluation of the dollar. The next one is real rates. Okay, if you were to go and plot Bitcoin against real rates, what you'll notice is that when a central bank puts rates very, very high, like the Fed did all the way up until July of 2023, so somewhere around here effectively, when central banks put interest rates up, in that environment, ultimately Bitcoin suffers a setback. Why? Well, because why would I own an asset that gives me no yield? Bitcoin doesn't yield you anything. It's just like gold. Right? So in a high interest rate environment, investors would far rather hold something like US bonds that gives them interest-free money. Okay. And likewise, when we're in a low interest rate environment, for example, when the central bank cut rates to the zero bound, we noticed that interest rates were very, very low. And at that time, Bitcoin began to rally up the page. Okay. And this is another very strong relationship for Bitcoin. And then finally is risk markets. Okay. Bitcoin is effectively and does effectively trade like a technology stock, right? And ultimately, how we know that and what confirms that is because if you go and look at the timing of the most recent rally in Bitcoin, and I'm just going to highlight this in a slightly different color. Okay? If you go and look at this period over here, late 2023, what you'll notice is at the same time, it was when the NASDAQ, when ultimately the S&P all began their rally. Okay, since that point, we're up around 38% in the S&P 500, and it triggered the Bitcoin rally, triggered off of the rally in risk in general. Okay, and we know that relationship to be true because we can see at the end of the day, the dollar did absolutely nothing in that time frame, and yet Bitcoin still rallied. Okay, we can see that the central banks kept interest rates high, into late 2023, and yet Bitcoin rallied. Okay, those are the three key fundamental stories that investors tell themselves when it comes to Bitcoin. One, dollar devaluation. Two, what are real rates doing? And finally, three, what are risk markets doing? Okay, let's apply the same exercise now to gold. Gold's very topical this year. It's up 33% this year. Why? The Fed put interest rates up at 5.75%. How come with such a high interest rate, gold rallied from $2,000 to $2,700? That doesn't make sense. Okay. Moreover, we've been seeing disinflation now for the last 18 months. Okay. And gold is up 33% this year. How can it be true that in a high yield environment and a low inflation environment that gold is rallied 33% this year? That fundamentally doesn't make any sense. Okay. And this is key because gold ultimately is driven also by three things. Number one, real rates. Number two, inflation expectations. And number three, balance sheet expansion. And I'm going to start with the final one first, which is balance sheet expansion. If you go look at gold and you look at the history of gold, it's had, I'd say, four major moves. Go back to 1974, and we saw a doubling of the price of gold from 200 to 400 bucks. Okay, that's around 1974. We then, of course, had the era where the Fed begun the process of cutting rates a bit too soon before inflation got back to its target. And as a result of that, we saw double-digit inflation in the United States. And at the same time, gold went from $400 to $800. Okay, so we had a doubling of gold in 1974 and again in 1978. Right, those are two key periods, and that's where this idea of gold being an acting as a hedge against inflation was born. It was born in 74 and 78. Okay. We then fast forward to, of course, 2007, 2008. What happened there? Well, this was the beginning of balance sheet expansion. Okay, it was the first time that we saw the Fed, a major central bank, use its balance sheet as ultimately a tool. Okay. Now, what happened was they took their balance sheet from around 300 billion to, of course, 4.5 trillion. The result? Gold doubled in price. Okay, if we go look at the period from 2010 to 2012, gold went from $1,000 to $2,000. Okay, 100% increase in a very short space of time. We then fast forward to COVID. Okay, and this is where we now kind of catch up to the chart. COVID started around Q1, somewhere around there. What did we see? Gold went from 1450, call it 1500, all the way up to $2,000. Okay, another 25% rally. Okay, these are the four major periods in history where we've seen significant movements in gold. And if you look at it, it's the only time really we've ever seen some significant movement in gold. Why? Well, because gold ultimately is just a store of value. It's a hedge. It's something every central bank holds on to, every government holds on to it. Why? Because they want to simply just diversify the assets that they hold. Okay, and it's no different for investors. We hold gold when ultimately the central bank is not willing to put interest rates high enough to combat inflation. Okay, now why do we hold gold in that instance? Well, look at a practical example. If the United States government gives me 5% to own its bonds, but inflation is running at 10%, I'm losing money. I'm losing 5% of my money. Okay, as a direct result, there's no point in me holding onto these bonds. I'd far rather hold gold in that instance. Okay, so in an environment where we have very negative real rates, I would far rather hold gold. And obviously the opposite is true. In an environment where we have very positive real rates, why would I want to hold on to gold? I'd rather hold on to the bonds because they're going to give me interest-free rate. They're going to give me free money effectively. Okay, so real rates are important ultimately for gold. But the most important thing, and this is the thing we learned now, why is gold up 33% this year despite inflation being back at the Fed's target? PCE is around 2.1, 2.2%, despite the fact that, of course, we do have a strong dollar environment this year. Why is it ultimately that gold's up 33%? What is it that's driving it? Well, it's quite simple. The Federal Reserve came out in this year, and they effectively told us that they are willing to move on policy without getting inflation back to their 2% target. Okay. Moreover, they told us that they're not emphasizing, they're not prioritizing inflation anymore because they would rather safeguard the labor market. In other words, they told us they have a willingness to accept above target inflation. And it's at that point, if you go look at the charts, it was January, February, March when we started to see the hotter inflation prints where Chairman Powell just said, well, you know, we're just going to accept them as speed bumps. It was at that time that the rally ignited ultimately in gold. Okay. Combined with that, there's this belief that ultimately inflation could prove to be sticky. We're going to see continued fiscal spending, and without further higher interest rates, we're not going to get inflation hovering around that 2% in the long run. It's going to be hovering perhaps higher, between 2.5% to 3%. Okay. All of this combined ultimately is what's driving the price of gold. And that's why ultimately we want to understand this story. Okay. So to summarize, gold is driven by real rates. It's driven by inflation expectations, which right now are rising. And finally, balance sheet expansion. Those are the three key drivers of gold. Those are the stories that we tell ourselves to stick with these trends. Now, to summarize, there are many, many narratives. Okay, narratives come and go. They're born all the time. And just a few of them: US soft landing versus hard landing versus no landing. Okay, that's stories that have been told over the last 12, 18 months. We've heard of the Magnificent Seven, the seven stocks that can do no wrong. They only ever go up. Effectively, they're a hedge against the rest of the market. We hear all sorts of crazy stories about the Mag 7, the AI future. Okay, we've spoken about this with NVIDIA. US growth dominance. Okay, we've heard this one quite a lot from Mohammed Al-Arian, where the US exceptionality, they can do no wrong. They grow at 2.6%, where every other global G7 country is barely growing above 0%. Okay, so we've heard this, and we've heard this being the reason as to why the S&P is up 30% this year. And then finally, some new narratives. We're starting to hear more and more about this fiscal debt sustainability, as US GDP to debt to GDP is almost at 100%. We're hearing the concerns around this. We're hearing these concerns around global recession. Okay. The key is your job is you just need to understand the stories. You need to be aware of the stories, and you need to understand and interpret how they impact specific prices. Okay. Most important, stick with the story. When the narrative shifts, you pivot. You don't have to know all the narratives. What is very important, though, is that you always need to be on the narrative that's trending. Stick with narratives that are trending. Trade markets where there's a narrative, because you're going to get natural flow in price. Okay. Now, final note on these narratives, and I mentioned this earlier, be very, very careful of narratives that have got no traction, but get a lot of attention. Perfect example. Right now, everyone is talking about the US fiscal deficit being out of control, and that debt to GDP could reach 200% by 2050. And investors are going to dump US bonds because of aggressive issuance. And the risk premium is going to go through the roof. And the Treasury is going to struggle to issue its bonds and struggle to fund itself. This is the narrative that's currently being told. However, this is ultimately a weak narrative. It's a narrative you have to be so careful of. Why? Because ultimately, this narrative's been around since Japan, since their debt to GDP crossed over 100% back in early 2000. We're now 2024. Moreover, Japan currently has the highest debt to GDP in the world at 260%. And guess what? Where are their bonds trading? 90 basis points. 90 basis points. Everyone in the early 2000s was talking about Japan's fiscal irresponsibility and how Japan was going to be, struggle as a result of it. And yet they can issue bonds at 90 basis points. Okay, so don't fall prey for weak narratives. The reality is that at the end of the day, if yields did start to move higher, the Fed can simply just do what the BOJ does. They can simply buy their own bonds. They've done it. They've got a balance sheet. They can just do QE and buy their own bonds and calm yields down. Okay, so don't fall for these weak narratives. Sure, they create short-term noise. I get that. They push the 10-year yield up 10, 15 basis points, and they sound sexy when they're the headline of the Financial Times. But in reality, they don't drive trends. And we know that to be true because we can look at past examples. Another temptation. It's so easy to hear and read and think about recessions. We all know that play. Recession's coming, I need to sell equities. Why are equities not going down in a recession? We all know that. We've all succumbed to that weak narrative. Don't fall prey to the recessionatis. They love to come out and talk about recessions, how we're going to fall off a cliff and it's going to be the end of the world. And yet go and look at the S&P performance. It averages 10, 11% year over year for the last 30 years. Okay. Stick to narratives that actually do drive price.